Okay, thank you guys for joining us. I'm here to introduce you to Emilie Raffo, who is the co-founder, founding partner, and head of sales at Chain Security. Thank you for joining us, Emilie.
Thank you. Hello. Ooh. Hello, everybody. So can I take this? No, that's not going to work. Thank you very much for coming. It's the end of the day, and I know that Darren is speaking over there, and still you chose me. I'm incredibly thankful. I'm going to put a timer here. Hello. Oh, amazing. So today I'll be talking to you about slashing insurance. First of all, I have to apologize. The title says sustainability. And I didn't mean environmental sustainability, I meant sustainability of business model. So if you're here to talk about the environment, I wouldn't be offended if you leave, because there's no environment in this presentation. So you might wonder why a smart contract auditing company would be talking about insurance. And like Clément just said before, it's because a lot of people are asking us if we're planning to offer insurance products. So we started looking into, would it make sense? Should we kind of start having this offering also? The answer is no. We're not going to do that because it is indeed, you have to. Insurance is not such an easy thing, as you guys might know. You need to be a risk professional, you need to raise capital, you need to do all these things, and we prefer to keep focusing on what we do best, the smart contract audits. But we still kind of interviewed a lot of people, did some research, and then I kind of found an interest to this insurance sector. So this is why I'm going to be talking about this today. And we also have some staking clients, so this is also interesting for me in that sense. Before starting, I'd like to thank all the people who gave me interviews. You have their Twitter handles there. And if at the Q&A you ask me a question I can't answer, I'm going to refer you to these people. So you can ask me a question, I will ask them. So yeah, they gave me interviews, so it's both on the kind of staking side and on the insurance side. And yeah, it was really invaluable for me to have their inputs. And some of them are in the room today, and I thank them again. All right, so before talking about insurance, I kind of wanted to talk about the different risks that you might want to insure and the different actors, right? So on the left, I've put the slashing risk, on the right, the downtime or offline risk. And so in terms of the slashing risk, I kind of have this kind of vision that as a solo staker, you're going to have less risk of slashing because you are less likely to have this infrastructure for backups to avoid downtime, so you're less likely to have this double signature, right? So this is why on the solo side, I've put the probability of slashing less, but the probability of downtime or being offline higher. For some of them, for example, for Rocket Pool, I've put kind of plus or minus because you can have professional stakers, professional node operators, and also solo. So this is why it's kind of both. Then in terms of the impact, so for solo stakers, obviously the impact is fully assumed by the solo staker. But then if you look, and that's I think kind of interesting, node operators like Lido are kind of these B2B. So when I put node operator, SAS, so it's staking as a service, so kind of this professional stakers, right? And there I've put the impact a lot for Lido. You're going to say, okay, but why it's not them who have the capital, right? So that's kind of strange. But actually, in the facts, it seems that in order to preserve their reputation, which is very important in the Lido ecosystem, right? You have to perform, otherwise you risk getting offboarded. So in the end, there is kind of a high risk that as a node operator, you're going to have to pay back these slashing penalties to the DAO to kind of maintain your reputation. And this is another side of the impact. It's not only something that is financial, it's also reputational. And if you lose your reputation, you lose your future ability to earn because you risk getting offboarded or you risk getting limited. However, for the professional node operators, more on the B2B, so the staking as a service, so maybe more in a traditional business model, offering these services to institutions and so on, I've put the impact a little less. This is a personal take, because I find that in a kind of traditional business model, you have maybe a bit more stickiness when you have these business relationships that you create with people, and if you kind of cover the penalties, there is less chance, I would say, that your business partner kind of leaves for a few things. Whereas with Lido, there is a lot of attention on you as a node operator, and you really have to perform because you have all these DAO members who are going to be pushing to get you out if you don't perform. So for Rocket Pool, I've put the impact as high because there is the collateral, but there the reputational risk is less important. And for Diva, you also have a collateral. Now, in terms of the downtime, so it's not a huge financial aspect of it. But again, for Lido, there is this reputation aspect. And also, I've looked at 10 cases of offline penalties and rewards missed and so on. And also, again, it was the node operator who paid it back on a voluntary basis to maintain the reputation with Lido. And for Rocket Pool and Diva, I've put the impact not too high because there's less that reputation aspect. And also these missed rewards and the penalties are socialized. So all of this to say, who would want to be insured in this whole thing? So potentially the liquidity providers for Rocket Pool, for Diva, they wouldn't really want to be insured because they're insured by this collateral, right? So the people who are taking this risk are the node operators. They're the ones who have their collateral at stake. So on this side, potentially, they could be the ones who want to get insured. Now, in terms of Lido and the B2B staking providers, it also depends on the contract, and also sometimes the node operators take on that risk and take on these penalties, even if they're not the ones contractually required to do so. So in this case, they might want to get insured. But also, the liquidity providers might want to get insured because maybe they don't trust the node operator to pay, or maybe they think, okay, this is too much of a risk to bear. And the solo stakers might also want to get insured because they have their stake there. So I compared these three insurance providers. It's obviously not the only three that exist, but it was kind of easy to find their data and to compare them. So yeah, I took Nexus, Chainproof, and Insurace. And so the first thing, obviously, is the fee. So it kind of depends on the proposal. So for example, if you look at the Nexus proposal and the Chainproof proposal for simple DVT for Lido, you can see somewhere that it went between 3 and 3.55%. But for example, Nexus for Figment offers it for 2.5%. What's interesting also is what is excluded. And I think that's kind of interesting, is that, so the missed rewards are quite often excluded, but also if there's a widespread network issue, so more than 10%. So if you're looking to get insurance for a catastrophic event, this type of event might be excluded. Bugs of the client software are also often excluded from insurance. So yeah, I think that's kind of interesting if you're comparing insurance providers, kind of what is excluded is super important. The max available coverage is also very interesting. So this was the max offered for, again, the simple DVT. If you look at Nexus and Chainproof, and Insurace is the max that is possible based on the capital that they have at the moment. So, in the other kind of DeFi insurances, you've seen that with the USD peg and all these kind of big events, a lot of insurance providers had to pay very big premiums, and kind of that wasn't great for the sustainability of their business model. So you have kind of these limitations in terms of risk that they want to expose themselves to because they want to be diversified. So for example, Nexus, you can go up to 20% of their capital pool to insure one type of risk. So I think that's like $56 million, 27,000 ETH. It's in the next slide. But so yeah, there are these limitations so that they would be able to pay if the thing actually happens. The deductible is also super interesting because I said if you have this huge catastrophic case, maybe it's not going to be covered. But also if you have this small case, maybe it's not going to be covered because it's lower than the deductible, right? So this is also something that's very important to look at when you're picking an insurance provider. Something that's very interesting, I interviewed these people and they haven't paid any claims yet. So this is a very sustainable business model, actually. So when you look at the rest of DeFi insurance, Nexus is actually the only insurance company in DeFi that has received more premiums than they have paid. All the other insurance providers have paid more than they have received. So it's a very, very rough space, and this is why we decided not to go in there, because people expect very high returns if they invest, in these insurance services. Then the clients expect to pay low premiums, and so it's kind of very, very complicated to manage this trilemma. Also of keeping the funds safe, of course. The KYC, kind of interesting. Insurance doesn't request KYC. And then the other thing that's kind of very different is that chain proof is a regulated insurance. So if they don't pay, you can sue them. So that's one thing. Whereas the other ones work on chain, as we know, kind of as crypto-native insurances. There's also Realm. There's also DSLA. There's also, some insurance from Blockdaemon with Munich Re. So there are other options, but I kind of put these three because it was kind of, 3 is a good number, I guess. Okay, so who does what? Lido has opted for self-insurance. They used to be insured with Unslash, and kind of the conclusion of it is that it was quite expensive. So the problem is that, what I showed you before, this here, so the yearly cost is in the percentage of the max value covered. So it's not the percentage of what you make, it's not the percentage of your profits. So actually, it takes quite a big chunk of your profits to insure your staked ETH. So the Lido kind of estimated that it was 25% of the revenue, what they paid in insurance, and they kind of thought that the risk wasn't really worth it to go with an external insurance provider. So now they have this self-insurance, so they have this fund which covers these cases. And we'll see afterwards a case and see how it was used and why. Rocket Pool and Diva, they have collateral, so the node operators deposit collateral. And then the B2B node operators, so these staking as a service, kind of these professionals, more on the kind of a traditional business model. So it seems that often they suggest, when you invest in them, they suggest that you take an insurance. So you can take an insurance with Figment or something with some of these providers, and then the liquidity provider is going to bear the cost of this insurance. But you also see in cases, for example, these cases here on top, stake.us, it's a node slashing event, but it was their fault, and they admitted to it, and then they paid back their clients. So we can see a lot of cases where it's a trust-based business, and when node operators commit a mistake, it seems that they often pay for it. And then the launch node case, so the two cases below are with Lido, and they're quite interesting. So for launch nodes, it was quite recent, it was last month, and it was a mistake by launch nodes, again, double signing and so on, because they had this backup that was triggered. And they paid back. Again, they paid back the DAO because it was their mistake and because they want to keep the relationship with Lido. So there, the Lido insurance fund wasn't even used. It was the node operator who bore the cost of the slashing. But with Rock Logic, it was different. So that happened in April, and it was actually a bug in Prism, in the client software. And there, so it wasn't their fault. I mean, some people argue with this, but it was judged that it wasn't their fault. And there, the Lido fund was used in this case because it was not the fault of the node operator. So I think it's kind of interesting to compare these two where the insurance wasn't used. I mean, a third-party insurance wasn't used. And I think it's interesting to see, okay, what if they had an insurance with Nexus or Insurace? Again, I took these two because it's kind of easy to see all the stats on chain. And so what's interesting is that, first of all, with Insurace, there is a maximum coverage, right? So if you look at huge node operators like Launch Nodes and Rock Logic, who have hundreds of millions under management, the max coverage wouldn't cover a big part. They would only cover 0.24 ETH per validator. Some people might say it's enough, some people might not say, it depends on how you see it. But in both cases with insurers, both events would have been covered, but the fee, the claim that would have been paid back would not have been as much as the yearly cost of the insurance. So having a self-insurance could have been an alternative to this. But interesting with Nexus, the RockLogic case, where it was a bug in the client software, and then the Lido insurance fund paid for it. Actually, this wouldn't have been covered in the terms of Nexus. So I think that's kind of interesting to see. So these are very rough calculations, right? I took ETH at 2K, just to kind of give a rough idea. But I think it's really interesting to see, okay, am I ready to take this risk or no? And is it worth paying for it? So if we look at number of slashings, so it's rated from this morning, you can see that maybe it's, I don't know. So it depends, kind of what is your risk tolerance. I'm very risk tolerant, so I think, I'm not sure. But, the people I interviewed, they kept mentioning that insurance is really, and they think is for institutional actors, is for people who are regulated, who want to offer to their clients this extra insurance. And maybe it's a little box that should be ticked by the compliance team, or maybe it's like car insurance, where you sell car insurance because it's mandatory. So a few people that I interviewed kind of see the evolution of this insurance sector for slashing to be connected with regulation and with the entrance of institutional investors, and that maybe crypto natives kind of are dealing quite well with these self-insurance solutions. So I'd like to thank again all the people who helped me with this and who gave me their insights. And thank you guys for being here at the last presentation.
Great, so we have some time for a couple of questions if anybody wants to ask questions. Questions? All right, I actually have one. Do you see insurance kind of disappearing as things can get built in protocol? And so if regulators in the future expected some kind of insurance to be, to come with some sort of protocol, do you think that could be built in a way that insurance wasn't necessary?
So having regulated insurance built into the protocol? So I think there you would have to have DAOs recognized by the authorities as a kind of a regulated insurance entity. For now, there are not that many kind of crypto native insurances that are regulated. So yeah, in the future where DAOs are legal entities that are recognized, I could see that, yeah.
Cool, thank you very much. Thanks for coming.
Thank you guys.
We have a 5-minute break, and then we're going to have Jorge Arce.